Last month, a guy in Ohio sat down to sign a 30-year mortgage at 6.6%. He looked at the loan officer and asked one simple question: who actually decided 6.6%? The officer smiled and said, "That is just where rates are right now." Most people hear that and move on. But the real answer matters more than most people realize. That rate was not chosen directly by his bank. It did not come directly from the Federal Reserve either. It emerged from a $145 trillion market. A market that reacts constantly to Fed policy, inflation expectations, and global risk appetite running beneath your entire financial life. This invisible machine sets your mortgage, your car loan, your boss's ability to make payroll. It determines whether your retirement fund loses 17% in a single year without anyone doing anything obviously wrong. Here is the contradiction most people never resolve. The safest investment in the world can destroy banks and freeze entire economies. And almost nobody understands how. If you do not understand bonds, you do not understand money. That changes today. The crazy part is it all comes down to one simple rule that 90% of investors get completely backwards. Let's start stupidly simple. A bond is just a formal IOU between a borrower and a lender. You give someone $1,000 today. They promise to pay you fixed interest every year. Then return your $1,000 on a specific date. Governments sell them, corporations sell them, cities sell them. The U.S. Treasury sells them to fund everything from highways to national defense. The annual interest payment is the coupon. The repayment date is the maturity. The original amount is the principal. That three-part structure, simple enough to explain in 30 seconds, underlies the largest financial market on earth. Because nearly every institution that has ever existed needs to borrow money. Bonds make that possible at a scale banks cannot match alone. But here is where everything breaks, and where most investors permanently lose the thread. Suppose you buy a bond paying 2% interest. 1 year later, new bonds are paying 5%. Who wants your old 2% bond now? Nobody. Not at the original price. So the market price of your bond drops until its return is competitive with the new 5% environment. You can lose real money on what was sold to you as the safest investment in the world. Write this down. For any given bond, price and yield move in opposite directions. When one rises, the other falls. When interest rates in the broader market rise, existing bond prices generally fall. When rates fall, prices generally rise. Everything else in this video is that one relationship operating at larger and larger scales across the entire U.S. economy. Now let us connect this to the most important benchmark number in American finance. It is not the Dow Jones or the S&P 500. It is the 10-year U.S. Treasury yield. This number changes every single day as investors reprice inflation expectations, economic growth, and risk across the globe. Banks do not invent your mortgage rate in a conference room. They look at the 10-year Treasury yield as a starting point. But the connection is not a fixed formula. Lenders also price mortgage-backed securities, borrower risk, and operating costs, and the profit required to make the loan viable. The bond market establishes the financial climate. Your lender then prices your specific mortgage inside that climate. When the 10-year yield was near 1% in 2021, mortgage rates hit 2.65%. Housing demand exploded. When the Fed hiked rates aggressively and the 10-year ripped higher, mortgages crossed 8% in late 2023. The market froze almost immediately. The bond market set those conditions. Not your bank. Not a political decision. One market, one benchmark. Millions of consequences downstream. Car loans, business credit, corporate borrowing, city infrastructure projects. All of it reprices when the bond market moves significantly. Cheap money fuels expansion. Businesses hire, build, and invest. Expensive money slams the brakes. Expansion pauses, and growth quietly decelerates. That deceleration does not start at the news headline. It starts weeks or months earlier in the Treasury market. Now let us talk about the most painful lesson most American investors learned in 2022. Bonds are not automatically safe. The word government in front of bond does not mean your principal is protected from market losses. In 2022, the Federal Reserve raised interest rates faster than at almost any point in modern financial history. Some long-duration Treasury funds lost more than 30% of their market value during that aggressive rate hiking cycle. Government-backed assets, enormous market losses. The supposedly safe half of a balanced portfolio made investor losses significantly worse that year. This happened because of duration risk, the measure of how sensitive a bond's price is to interest rate changes. A 3-month Treasury bill barely moves when rates change. A 30-year Treasury bond can swing violently on a small rate shift. Same U.S. government backing. Completely different risk profile. Most investors in 2022 had no idea which version they were holding, and the same dynamic contributed significantly to the collapse of Silicon Valley Bank in 2023. SVB had parked billions in long-duration government bonds, mathematically sound on paper, backed by the U.S. Treasury. When the Fed raised rates, those bonds lost over $15 billion in market value. Depositors panicked and demanded cash. SVB had to sell at catastrophic losses to meet withdrawals. Duration risk created the losses, but concentrated uninsured deposits, failed liquidity planning, and management failures turned those losses into a fatal bank run. The 16th largest bank in America collapsed in 48 hours. Not fraud, not bad loans, a combination of duration exposure and operational failure. Bonds also move political outcomes. During the 2023 U.S. debt ceiling standoff, Treasury yields spiked before Congress reached any resolution. Bond investors did not wait for politicians. They demanded higher yields immediately to compensate for uncertainty about repayment. Fitch downgraded U.S. sovereign debt in August 2023, a historic moment for American credit. Moody's followed in May 2025, removing America's final top rating from a major agency. One market, decades of institutional trust being repriced in real time. The bond market speaks before anyone else does. Now let us talk about the bond market's most powerful early warning signal, the yield curve. The yield curve compares interest rates across all U.S. Treasury maturities, from 3-month bills out to 30-year bonds. Normally, the curve slopes upward. Longer maturities pay more because investors demand compensation for waiting longer and accepting greater uncertainty. But sometimes the curve inverts. Short-term treasuries start paying more than long-term ones. That inversion is historically significant. Particular yield curve inversions have preceded every U.S. recession in recent decades, although timing varies and false signals remain possible. In 2022 and 2023, the yield curve inverted more deeply than it had in 4 decades. Institutional investors were already repricing the slowdown. While retail investors watched daily stock movements, the bond market had already moved. Bonds speak first. Stocks follow the echo. Now the second force that quietly destroys bond returns while investors feel safe. Inflation. Imagine you lock money into a 10-year Treasury, paying 4%. Prices in the economy rise at 6% annually. You are not making 4% in real terms. You are losing 2% of your purchasing power every year. For 10 years, your nominal return looks fine on paper. Your real return is negative. The bond performed as promised and still made you poorer. This is one reason inflation matters across finance. It changes real returns, borrowing costs, household purchasing power, and Federal Reserve policy simultaneously. When inflation surges, bond investors demand higher yields to compensate. Existing bond prices fall. The seesaw tips hard. When inflation cools, investors accept lower yields. Existing bonds with higher coupons become more valuable. Prices rise. This dynamic plays out across trillions of dollars every single day in the U.S. Treasury market. So, what should an ordinary American investor actually do with this knowledge? First, stop accepting near zero interest on your cash savings. The national average savings account pays almost nothing. 3-month Treasury bills are direct U.S. government obligations currently paying around 4 to 5%. You can buy them directly at treasurydirect.gov with zero fees and no middleman. Most Americans have never done this. They should consider it. High-yield money market funds may also hold government securities and pay competitive rates, but they are investment products, not FDIC-insured bank deposits. Know the difference before choosing where to put your cash. Safety means something specific in finance. Second, understand the difference between individual treasury bonds and bond funds. Hold an individual treasury to maturity, and you receive its face value, assuming the government pays as promised. A bond fund has no single maturity date. Its price can fall when rates rise, although higher yields may help it recover through future income over time. Neither is automatically better. They solve different problems for different time horizons and needs. Third, always check duration before buying any bond or bond fund. It tells you how much your investment drops for every 1% rise in rates. A duration of 10 means a 1% rate rise drops your fund by roughly 10%. Know this before committing capital. Fourth, if inflation is a specific concern for your situation, look into Series 1 savings bonds or Treasury inflation-protected securities. TIPS adjust their principal with official CPI data. They can be worth researching when inflation protection matches the specific job you need that money to perform. Fifth, watch the 10-year Treasury yield the way you check the weather. It is the economy's most reliable check engine light. When the 10-year rises, and your future borrowing costs tend to rise with it, mortgages, car loans, business credit, all of it follows. When the 10-year falls, borrowing becomes cheaper, asset prices tend to rise, and economic conditions generally loosen. Now let us come full circle. Back to the guy in Ohio. Back to 6.6% that nobody explained. He was not the victim of a bank decision. It was the downstream output of global bond investors demanding a specific return. Bond investors around the world decided what return they required to lend for 10 years. That decision flowed into his mortgage in Ohio. This is happening to you right now. Every debt you carry, every rate you pay, every return your retirement account generates or fails to generate. The bond market is already inside your financial life. You just did not have the framework to see it until now. Now you do. Any bond, when rates rise, prices fall. That single truth explains more about your financial life than almost anything else. The bond market will keep pricing your future, whether you understand it or not. The only question is whether you see it coming. Drop one word in the comments: yield. That is the number that has been quietly running your financial life all along. Keep thinking stick.